Welcome back to the SafeSimpleSound podcast. This is the space where we believe that financial clarity isn't just about the numbers. It's about creating a life that is lie sound. We are dedicated to finding the both and solutions to the contradictions families face in their financial lives. Today marks a significant milestone in our journey together. We have arrived at the summit of our four-part series on understanding risk measurement. If you've been with us for the last few episodes, you know we've been building a house, a fortress, really, designed to withstand the changing seasons of the economy. We started by separating noise from danger when we discussed volatility. We prepared for the impossible by looking at fat tails, those rare, high-impact events. We engineered structural safety by exploring correlation, how different assets move in relation to one another. But today is the final critical inspection. Today, we answer the question, will it actually hold up? In our practice at SafeSimpleSound, we often see families who have done the hard work of saving and investing, yet they still carry a low-level anxiety. They wonder, is this enough? What if the worst happens? The topic of today's episode is stress testing your future. It's the same topic we recently detailed in our written blog series, because we believe that the difference between anxiety and peace of mind usually comes down to one specific contradiction: hope versus verification. Most traditional financial plans are built on hope. We hope the averages play out. We hope the markets behave. We hope our health holds up. But hope, while a beautiful human virtue, is a fragile architectural strategy. Through our S3 framework, we propose a different approach: verification. Whether you are 5 years from retirement or 5 years into it, this episode is designed to give you the tools to move from guessing about your future to verifying it. We're going to look at the sound principles of value at risk and the vital distinction between your risk tolerance and your risk capacity. So, take a deep breath. Let's set aside the noise of the daily news cycle, and let's get to work on verifying your legacy. Let's begin by establishing our foundation. In the SafeSimpleSound philosophy, we often talk about the concept of time coexistence. This is the principle that a sound financial plan must respect the wisdom of history, the past, while securing your specific needs in the here and now, the present and future. When we talk about risk, the industry often defaults to averages. You've likely heard phrases like, the market averages 8 to 10% over the long run. And while that is historically true, you do not live in the long-run average. You live in specific years, specific months, and specific days. You live in the variance. In our practice, we've observed that many families build their entire future on a fair weather model. It's like building a boat that is designed to sail beautifully only when the waters are calm, but the ocean is rarely calm for 30 years straight. If your plan relies on the market doing what it's supposed to do, you are relying on hope. And when the market inevitably misbehaves, hope turns into panic. Panic leads to emotional decision-making, and emotional decision-making is the enemy of wealth preservation. From a safe, simple, sound perspective, we want to replace that panic with predictability. We want to replace surprise with expectation. This brings us to our first major concept today: stress testing. To make this simple, think about the automotive industry. Before a car manufacturer sells a new model to a family, they don't just hope it's safe. They don't just drive it around the block on a sunny day. They crash it. They put it in wind tunnels. They freeze it. They overheat it. They stress test it to see exactly where the breaking point is. In financial planning, stress testing means taking your portfolio and your financial plan and mathematically subjecting them to the worst scenarios history has to offer. We model the black swans we discussed in part 2. We simulate the lost decades. We break the plan on paper so that it doesn't break in real life. This provides the safe component of our framework. Safety doesn't mean nothing bad ever happens. Safety means knowing that when bad things happen, the structure holds. Now, to do this effectively, our team utilizes a metric used by institutional investors called value at risk, or VR. Now, don't let the technical jargon push you away. Let's translate this into plain English. If we asked you, how much of your portfolio could you lose in a single bad month? And your answer is, I don't know. You are essentially investing with a blindfold on. You are walking a tightrope without knowing how far down the ground is. Value at risk answers a very specific, empowering question. With 95% confidence, what is the worst case loss I could suffer over a specific period of time? Let's break that down. It's not a crystal ball. It doesn't predict the future. It measures downside potential. Imagine you have a portfolio of $1,000. A generic advisor might say it's moderately aggressive. That's vague. That's noise. A plan using VR might say, based on the historical behavior of these assets, there is a 95% probability that you will not lose more than $50,000 in any given month. Why does this matter? It matters because of psychology. If you know your portfolio could drop $50,000 in a bad month, and then a crisis hits and it drops $40,000, you don't panic. You don't sell everything and move to cash. You look at the plan and say, okay, we expected this. This is within the verified limits of our architecture. You have turned a potential catastrophe into a managed expectation. That is the power of verification over hope. This leads us to the second major pillar of today's discussion, and perhaps the most personal one. It is the contradiction between risk tolerance and risk capacity. In the financial world, these terms are often used interchangeably, but in our S3 framework, they represent two completely different forces. Risk tolerance is psychology. It is how you feel about losing money. It's your emotional sleep number. Are you a daredevil? Are you cautious? It's subjective. Risk capacity is physics. It is your mathematical ability to lose money without ruining your plans. It is objective reality. This is where we see the greatest tension in financial planning. Often, these two are at war. You might feel like a daredevil, high tolerance, because you've seen the markets go up for 10 years. But if you have a tuition payment due in 6 months, your physics, your capacity, is actually very low. You cannot afford to lose that money, regardless of how brave you feel. Conversely, you might be terrified of the market, low tolerance. Maybe you grew up with financial scarcity, but you might have a 30-year time horizon and millions in the bank. Your physics says you have high capacity. A sound plan respects your feelings, your tolerance, but it must be anchored in your physics, your capacity. When we confuse how we feel with what we can mathematically afford, we make errors. We take risks we can't afford, or we avoid opportunities we need to take. The goal of financial planning is to align your psychology with your physics. To illustrate how this principle plays out in real life, let me share a hypothetical scenario that illustrates the tension between tolerance and capacity. Please note that while this story is created for educational purposes to demonstrate S3 principles, it is a fictional composite. It demonstrates patterns we observe when families apply SafeSimpleSound thinking to their retirement planning, but it does not depict any specific real-world client. Let's picture a fictional couple. Let's call them the Millers. Robert and Sarah, both aged 62. Robert and Sarah have been diligent savers. They have built a nest egg of $2 million. They are looking to retire in exactly 3 years at age 65. They also have a daughter, Emily, who is starting medical school next year, and they have committed to paying for a significant portion of her tuition. Now, let's look at their psychology risk tolerance versus their physics risk capacity. Robert is an engineer. He looks at the past decade of market returns, sees the S&P 500 doing well, and he feels confident. He scores very high on traditional risk tolerance questionnaires. He says things like, "I don't mind the ups and downs, I want growth." His tolerance is high. Sarah is more cautious, but she trusts Robert's judgment, so their portfolio is positioned very aggressively, mostly in stocks, with very little structural protection. On the surface, this looks fine because the market has been going up. However, let's look at their physics risk capacity. They need to withdraw a large lump sum for medical school tuition in 12 months. They need to start drawing income for retirement in 36 months. Because their time horizon for these cash outflows is so short, their mathematical ability to withstand a major loss is actually low. There is a dangerous gap here. Their psychology says full speed ahead, but their physics says caution, bridge out. In our hypothetical scenario, the Millers come to a practice like SafeSimpleSound. We don't just ask them how they feel. We run a stress test. We apply a scenario similar to the 2008 financial crisis or the 2000 dot-com bubble to their current portfolio. The stress test reveals that in a severe bear market scenario, their $2 million portfolio could draw down by 35%. That's a loss of $700,000. Now, we sit down with Robert and Sarah. We show them the numbers. Robert, we say, if your portfolio drops to $1.3 million next year, right when you need to pay for Emily's medical school, how does that impact your retirement date? The math, the physics, shows that a loss of that magnitude would force them to delay retirement by 5 years, or tell their daughter they can't fund her school. Suddenly, Robert's high tolerance evaporates. When faced with the verification of what a loss actually means for his life goals, he realizes his plan wasn't sound. It was built on the hope that a crash wouldn't happen in the next 3 years. So, how do we fix this using S3 principles? We don't necessarily abandon growth, but we must respect the physics. 1. Segregating the liability. We identify the money needed for medical school short-term need and move it out of the volatility of the stock market. We place it in safe, stable instruments. We align that specific bucket with a low-risk capacity. 2. Balancing the portfolio. We introduce assets that are non-correlated to the stock market, things that might hold value or go up when stocks go down, as we discussed in our last episode on correlation. 3. Rerunning the stress test. We adjust the portfolio until the worst-case scenario number is something that allows them to still retire on time, even if the market crashes. By doing this, we might lower their potential upside slightly. Maybe they won't make as much in a booming market, but we have eliminated the risk of ruin. We have ensured that their legacy and their promises to their daughter are sound. While the story of the Millers is fictional, it demonstrates how our framework protects families. We often see this pattern. Families assume that because they have enough money, high capacity in the long run, they can take maximum risk. But they forget about sequence of returns risk, the risk of a bad market hitting right when you need to spend the money. Through this example, you can see how thinking applies. It's not about judging Robert for wanting growth. Growth is good. It's about verifying that his desire for growth doesn't sabotage his need for stability. It's about time coexistence. We let the long-term money grow future while we protect the short-term money present, both and. Whether you're facing this exact situation with tuition payments, or maybe buying a vacation home, or simply stepping into retirement, the principle remains. Physics must always override psychology. As we begin to close out this episode and our risk architecture series, let's synthesize what we've learned. We have traversed the landscape of risk. We learned that volatility is the price of admission for growth, but it must be managed. We learned that fat tails, those rare extreme events, are inevitable, and we must build walls thick enough to withstand them. We learned that correlation is the engineering tool that keeps the roof from collapsing when the walls shake. And today, we learned that stress testing is the ultimate safety check, the bridge between hope and verification. A financial plan is not one that avoids risk. A ship in a harbor is safe, but that is not what ships are built for. Your capital is built to do work, to support your lifestyle, your family, and your legacy. You must take risk to outpace inflation and achieve your goals. But, drawing from our SafeSimpleSound methodology, we believe you should only take risks that you have verified. You should know your value at risk. You should know the difference between your emotional tolerance and your mathematical capacity. When you know exactly how much weight the bridge can hold, you can cross it without fear. That is the definition of financial freedom. It isn't the absence of danger, it is the presence of preparedness. So where do you go from here? How do you apply this to your own life? This episode draws from our recent blog post, Stress Testing Your Future, which you can find at SafeSimpleSound.com. We have created 2 specific resources to help you bridge the gap between this audio experience and your real-world planning. Through our S3 approach development, we've created 1. The Structural Integrity Scorecard. This is a simple tool designed to help you measure the gap between your risk tolerance and your risk capacity. It prompts you to ask the hard questions before the market asks them for you. 2. The S3 Blueprint. This provides the complete risk hierarchy model we use at SafeSimpleSound to build all-weather portfolios. If today's insights resonate with your family's situation, if you recognized yourself in the story of the Millers, or if you realized you've been relying more on hope than verification, we invite you to explore what financial planning could look like through our Safe, Simple Sound practice. We offer a clarity diagnostic meeting where we can move from reading about risk to actively measuring it for your specific situation. But whether you choose to engage with our practice or not, our hope is that you are now equipped with a capability that serves you well. We want you to look at your financial future not with anxiety, but with the quiet confidence of someone who has checked the foundation and knows it is sound. Thank you for journeying with us through this series. We look forward to continuing to build a safe, simple, and sound future with you in our next series. Until then, keep verifying.